Foreign portfolio investors or FPIs took a sharp U-turn in October and snapped their 3-month streak, turning net sellers in the Indian markets. This is because of the ongoing geopolitical tensions. Now, this comes after an aggressive buying streak recorded in September, when FPI inflows were the highest year to date, up to 57,724 crores in the month of September, which was a 9-month high. This was boosted by the supersized 50 basis point interest rates cut by the US Federal Reserve this year. But things are changing. Remember this clip in which Pan Gongsheng, the People Bank of China's governor, is announcing some key revival steps for the Chinese economy.
第一项呢是降低存款准备金率和政策利率，近期将下调存款准备金率0.5个百分点，向金融市场提供长期的流动性约1万亿元。二是降低存量房贷利率和统一房贷再低首付比例，引导商业银行将存量房贷利率降至新发放贷款利率的附近，预计平均的降幅大约在0.5个百分点左右。统一首套房和二套房的房贷再低首付比例，将全国层面的二套房贷款再低首付比例由当前的25%下调到15%。
Now, post these announcements, war in the Middle East, and today's RBI's maintenance of status quo in the key interest rates, the FPIs have been pulling their money out of the Indian equities and putting them where? On reasonably valued Chinese stocks. Hello, my name is Abhinav Trivedi and you're watching Mint Explains. Now, there is an ongoing buy China, sell India strategy in October, leading to the offloading of 30,718 crores in Indian equities over just 3 trading sessions in October. Now, foreign brokerages are turning positive on Chinese shares. In fact, Goldman Sachs, in its latest note, asked investors not to fight PBOC, the Chinese central bank, which is extending unprecedented and unorthodox support to Chinese equity markets. It said that this time is different in terms of policy response, and investors of Chinese equities are getting what they were hoping to a large extent. Now, will this impact India? Not much, feels the markets and analysts. And we shall explain how. Now, it's true that Chinese stocks are trading at much more attractive valuation than India. But market experts remain optimistic about India's market resilience, citing robust retail investor participation. In fact, domestic mutual funds have pumped nearly $30 billion into Indian equities this year, far outpacing the $10 billion invested by FPIs. Now, why China is still a developing story? Despite China's current rally, many foreign investors remain cautious about investing there, and much will depend on the long-term recovery of the Chinese economy, which means investors are waiting for the real money. Most of these stimulus are funded by debt, the oldest trick in the bag, and currently the biggest trouble for China's real estate and property bubble. Investors are cautious about real impact on ground than just headlines. There is a sentiment that while China has pledged fiscal support, details are still lacking, and should China disappoint on announcement and execution, investors will likely be quick to bounce back into Indian equities. In fact, Harsimran Sahni, EVP and Head Treasury Anand Rathi Global Finance, spoke to Mint and said that Chinese financial indices are very cheap based on historical valuation and a price-to-earning basis compared to Indian indices which trade expensively. FPIs only started participating in Indian markets and buying has picked up from FPIs in the last 2 months. India's fast-growing economy attracts positive interest from overseas investors and is well placed to benefit if Western companies want to diversify their supply chains from India. China's GDP is larger than India's GDP, but India's pace of GDP growth is now outstripping Chinese growth. So, the Chinese story might bring some transition in the FPI flow for some time, but main damage can only happen if long-term effects are visible in returns on ground in China. And that's possible with real economic growth of China. Therefore, let's wait and watch. As of now, Indian market experts and analysts are keeping a wait and watch approach, and we shall see how this FPI to and fro activity persists in the next 30 days. That will decide whether the FPIs are actually dumping India for China. For now, this is all from this episode. We shall see you on the next one. Bye-bye.